Last week, Coinbase CEO Brian Armstrong went on social media with an ominous message. U.S. regulators would try to get rid of staking, a service that gives retail investors access to some of the safest yields in crypto. A day later, the country's top financial watchdog said it had reached a settlement with crypto exchange Kraken, which would stop offering its staking service there. Then, on Monday, Paxos said it would stop issuing new stablecoins at the request of the New York Department of Financial Services. These headline-grabbing moves are the latest in a flurry of regulatory action that crypto investor and influencer Nic Carter calls Operation Chokepoint 2.0, a, quote, sophisticated, widespread crackdown against the crypto industry in the United States. Today, we're going to dive into this new regulatory crackdown and what it might mean for crypto writ large. Thanks to MetaMask for sponsoring this video. MetaMask Learn Web3 with a leading Web3 wallet. In an essay published on the Substack newsletter Pirate Wires, Nic Carter lays out the worst-case scenario of this regulatory crackdown. Even the most steely-eyed crypto veterans, he writes, are nervous that crypto businesses might end up completely unbanked, stablecoins may be stranded and unable to manage flows in and out of crypto, and exchanges might be shut off from the banking system entirely. Whether the situation is indeed so bleak for crypto is a matter of debate, but there's no doubt that U.S. regulators, most visibly the U.S. Securities and Exchange Commission, are newly emboldened, suing and fining companies for alleged violations of U.S. law. The SEC is the primary financial regulatory authority in the U.S. with a mandate to protect retail investors. Last year, the SEC announced it had nearly doubled the size of its crypto unit, with 50 people, supervisors, trial attorneys, investigative attorneys, analysts. The SEC will be better equipped to police wrongdoing in the crypto markets, Chairman Gary Gensler said in a news release. The unit was created in 2017, and at the time of that announcement last May, it had brought more than 80 cases against alleged wrongdoers in the crypto industry. That's a little less than 16 a year. We've seen the fruit of that investment. In the 9 months since, there have been at least 17 cases brought against crypto industry players, according to a quick scan of SEC press releases. 5 of those have come in 2023 alone, and we're not even halfway through February. In most of these cases, the SEC's allegations are straightforward. The business in its crosshairs has offered a product, whether it be a token or a yield-bearing account, that can be characterized as a security and should be registered as such. On February 8th, Brian Armstrong, the CEO of Coinbase, said he was hearing rumors that the SEC would like to get rid of crypto staking in the US for retail customers. Less than 24 hours later, the SEC announced that one of its targets, crypto exchange Kraken, had settled a lawsuit. The SEC alleged that one of Kraken's yield-bearing products, a service in which it would stake customers' crypto on their behalf, was an unregistered security. In a whimsical 3-minute video shared on social media, Gensler explained the Commission's rationale for pursuing Kraken and the registration of securities more generally. Here's the rub. When a company or a platform offers you these kinds of returns, that relationship should come with the protections of federal securities laws, he said. That means you, the investor, should receive important disclosures. For example, what do they actually do with your tokens? Are they really staking them? Are they lending, borrowing, or trading with them? Are they commingling them with their other businesses? Where do the rewards come from? Are you getting your fair share? Are the underlying crypto protocols genuinely creating value on your investment? Or are they just new tokens that dilute the value of the ones that you already have? This high-minded talk has spawned dozens of memes mocking the SEC for protecting retail investors from Kraken and Kim Kardashian, while Sam Bankman-Fried stole billions from FTX customers, allegedly. More substantively, it spawned all sorts of analyses from crypto lawyers arguing this or that token or staking product is not, in fact, a security. We're not going to get into the nitty-gritty of securities laws here. There's plenty you can read on that elsewhere, and in any case, it's boring. The key takeaway is that the crypto industry almost unanimously disagrees, and some deep-pocketed players are willing to put up a fight. Coinbase's staking services are not securities, Armstrong tweeted. We will happily defend this in court if needed. Paxos also said it would go to court over the securities question. The firm teamed up with Binance, the world's largest crypto exchange, to issue the dollar-pegged BUSD stablecoin several years ago. On February 3rd, the SEC sent Paxos a letter that said it was considering taking action against the company on the grounds that BUSD is an unregistered security. Paxos categorically disagrees with the SEC staff because BUSD is not a security under the federal securities laws, the company said in a statement. We will engage with the SEC staff on this issue and are prepared to vigorously litigate if necessary. Just a couple hours earlier, however, news broke that Paxos had been ordered by the financial regulator for the state of New York to stop issuing new BUSD tokens. According to the Wall Street Journal, which broke the story, the New York Department of Financial Services found that Paxos, quote, failed to conduct periodic risk assessments and due diligence, of Binance and customers holding BUSD issued by Paxos. What's at stake here? Well, one crypto firm that went through the trouble of creating an SEC-registered token paid $2 million in legal fees alone, its founder told DL News. It might not be much for a company like Coinbase or Kraken, but it's a ton for a startup, especially those that eschew venture capital. But, as Nic Carter notes, the crypto crackdown goes beyond the question of whether certain tokens and centralized exchange products are securities. We'll get into that in just a moment, but first, a word from our sponsor. MetaMask Learn is an educational platform designed to immerse you in the world of Web3, what it is, why it matters, and how to get started. You'll learn core concepts and fresh and engaging lessons from the world's leading self-custodial wallet. MetaMask Learn is for you if you've been interested in Web3 but just don't know where to start, you've bought some crypto on an exchange but don't know what to do with it, you still don't understand Web3 principles because they've been too jargon heavy, you want to know what the fuss about Web3 really is. Back to our story. Other U.S. regulators involved in this alleged Operation Chokepoint include the Federal Reserve, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency. Custodia, a bank servicing crypto clients, has applied for a FedMaster account and membership in the Federal Reserve System, both of which were denied last month. Banks with Fed membership and master accounts enjoy myriad financial benefits, including access to some of the safest yield in traditional finance. Custodia, quote, proposed to engage in novel and untested crypto activities, the Federal Reserve said in a statement, activities that are highly likely to be inconsistent with safe and sound banking practices. And as Carter notes, the aforementioned trio of regulators released a joint statement last month on crypto asset risks to banking organizations. Quote, it's important that risks related to the crypto asset sector that cannot be mitigated or controlled do not migrate to the banking system, the joint statement reads. Although it goes on to say that banks are neither prohibited nor discouraged from providing banking services to customers of any specific class or type, Carter argues this statement, as well as others from bureaucrats and lawmakers, are a strong deterrent to any bank considering aligning itself with crypto. Carter says it's a crisis, a regulatory onslaught with little justification. Some might be sympathetic to regulators' attempts to insulate the banking system from the vicissitudes of the crypto space, Carter writes. But thus far, crypto's various disasters haven't produced any meaningful contagion. The fact is, however, that it may not have produced any contagion precisely because it was so isolated from the financial sector. Crypto is risky business, and investors do deserve to know exactly what they're investing in and how their deposits are being used. The question is, what's the regulator's endgame? Is it, as Carter argues, to completely debank crypto? Or is it to convince an industry that abhors regulations to start playing by the time-tested rules that apply to everyone else in the financial world? If it's the former, crypto's future in the US looks bleak. Uniswap founder Hayden Adams took to Twitter Monday to say that it's, quote, embarrassing to watch the United States fumble the ball so hard on crypto. The incentive for innovators and businesses is to go abroad. Uniswap is one of several marquee crypto businesses based in the US. Its peers include Coinbase, Optimism, and Arbitrum. Would they stick around if they were cut off from traditional banks? Could they? The answer is likely no. Unless you're willing to meet someone in person and hand them a stack of cash in exchange for some crypto, banks are still the only on and off ramps to the world of digital assets. The Achilles heel in a system that's supposed to be resistant to government censorship. So if you care about crypto, you've got to pay attention to what happens there. For better or worse, the industry's future will depend on it.